Hey there. This will be another entry in our series on beginning options trading. What I want to do here is discuss how options are priced in more of an intuitive way rather than going into the hardcore mathematics. We can do that in a later video. So in this video, I'm going to talk mainly about put options. The same can be applied for call options, but I think put in this context is going to be easier to understand because I'm going to discuss things in terms of insurance policies, which everybody should intuitively understand. So the things that are really affecting the option price, there are only a handful of them. I'm going to ignore interest rates. I put that at the bottom, but that's not really important for retail traders because interest rates don't change on a big enough basis frequently enough to make a difference. So the main things we have to worry about are the stock price, the strike price, the time to expiration, and what's called the implied volatility. Now, the first three of those are going to be very, very straightforward and easy to understand. The implied volatility is a little bit more abstract, and we'll go into that in a little bit more detail. So let's take care of the low-hanging fruit with those first three first. We'll switch over to tasty, and we'll discuss stock price, strike price, and not implied volatility, time to expiration. So here we have an option chain for Apple. So again, let's make a comparison to buying insurance. If you're insuring a $5 million house, for example, you're going to be paying a lot more for insurance than if you're insuring a $100,000 house. That just makes sense. Okay, the same is going to hold true for the options. So if we go to the September option chain, so the stock is roughly about $230. If we go to the September option chain and look at the first out of the money put, so that's here. That's the 225 line. We're going to be paying $5 roughly 545 for that put if we wanted to buy it. Okay, so let's go to a lot cheaper stock. Again, this is pretty straightforward and obvious. Let's go to AT&T, which is like a $27 stock, so it's significantly cheaper. And right again, you'll see the first out of the money put is right here. I have a position in AT&T, and that option is only trading for 38 cents. So significantly cheaper. So I don't know, let's switch back to Apple and talk about AAPL, talk about the strike price. Again, this is pretty obvious. You can draw an insurance analogy again. If you're insuring the house for the full value it's worth, so if it's worth $5 million and you're buying a policy that's going to cover the entire $5 million, that's going to cost more than if you're only insuring half of the value of the house. So correspondingly, this put here is going to be the most expensive of the out of the money puts. Okay, this is trading for roughly $5.45, and it's at the what is this, 225 line. So if we go down to the 200, I may have to make an adjustment here on Monday. The stock price is getting close to my call strike, so I'm going to have to bring this put up. But that's not relevant to here. So we started at the 225 put. If we go down to like the 200 put, so we're not covering as much of the value as we were with the at the money, and you see that this put is significantly cheaper. The same thing is going to hold true for time to expiration. So let's cancel this out here. If we look at the 210 line, so this would be like buying a longer term insurance policy. The greater the time span that the policy is active, the more you're going to pay for it, right? So this 210 line is trading for roughly $1.92, okay? And this put expires in 40 days from now. So if we go to the line that's expiring 5 days from now, and we look at that, what strike was it? It was the 210. Let's cancel that and go to the 210 line. This is only a handful of cents. So again, this is just entirely intuitive, right? The longer the duration, the more you're going to pay for it. And we're now up to implied volatility, and that's the one that's really the more abstract of these. So implied volatility is the perceived risk, the perception of movement in the stock. Going back to our insurance analogy, I live in Southern California and there's always a risk of wildfires. Suppose you were insuring your house fire insurance month to month. Well, in the winter, it's rainy usually here, or rainier, wetter. So you would think the policies would be cheaper because the odds of a disastrous fire are less when it is wet out. Conversely, during the dry time of year, which is usually in mid to late autumn here, the risk is a lot higher because we haven't had rain the whole year. The odds of a fire are higher, and the odds of that fire really burning everything, because everything is drier, is significantly higher. Therefore, you would expect to pay more for that policy. So with stocks, this perception of risks tends to increase either around specific events, like a company declaring, a company having earnings or some sort of corporate announcement. Implied volatility across the whole market tends to expand when there's a big sell-off. So a few weeks ago, we saw the S&P 500 sell off about 120 points, about a 2% drop. The implied volatility went from the 17% range all the way up to 20% range, which is a pretty big increase just for a one-day move. So let's go back to our trading platform, clear out this trade here. I'm going to look at Micron because they have earnings coming up in the next couple months. So here on Tasty Trade, the implied volatility of the option chain, kind of an average implied volatility, is displayed on this right-hand side. So you see that these values are about 48, 49% here. And then there's an earnings announcement here on the 24th of September. And in this option chain, the implied volatility suddenly jumps to 52% because an earnings announcement could cause the stock to move. If they miss earnings, the stock could drop precipitously. If they blow it out, it could explode to the upside. So increased perception of movement, higher implied volatility, higher actual options prices. And then in subsequent months, the implied volatility drops back down to its typical value. So as someone who sells premium, someone who sells options rather than buys them, we generally want to sell them into a higher implied volatility. If you're selling something, you want to sell something that's expensive compared to something that's cheap. And there are a lot of interesting facts about implied volatility. On the average market, implied volatility tends to contract more often than it expands, at about a 2-to-1 ratio. So if every 2 days you tend to have like a contraction in volatility, and 1 out of 3 you have an expand. The thing about volatility expansion is that when it does expand, it can expand in a huge way. During the COVID shutdowns, we had at times, if I remember correctly, the VIX, which tracks the S&P 500 volatility, actually got up into the 90s when it's typically in the teens, and that happened just over a span of a couple of days. A couple of weeks ago, we just had 1 day of a sell-off, and all of a sudden implied volatility jumped by 3 percentage points. So if you were on the losing side of that, if you had sold options like I did, for a couple of days there, you were feeling a bit of pain because the options that you had sold got more expensive with the expansion in volatility. So that's it for today, a quick conceptual video. If you guys have any questions, please feel free to leave them in the comments. If you have any topics that you want me to cover, again, just leave them in the comments and I can get around to them. So that's it for me. Good trading this coming week, and until next time, see ya.